How are options priced? Really important section, folks. You really need to come back to this section over and over again until you're really comfortable with it. So, what is option premium? Well, option premium is the same as the option price. And the option price or option premium is equal to intrinsic value plus time value. Now, intrinsic value here is also known as real value. But before we get into discussing that particular formula, you need to know three key terms. One is in the money, out of the money, and at the money. So here's a chart showing you what in the money, out of the money, and at the money means for call options and for put options. So when the share price is higher than the strike price, a call option is said to be in the money. And it's the exact opposite for the put option, that's said to be out of the money. When the share price is lower than the strike price, the call option is out of the money and the put option is in the money. And then when the strike price is the exact same as the share price, both a call option and a put option are at the money. So back to our little formula. What is this intrinsic or real value? So to calculate intrinsic or real value, it's the share price minus the in the money strike price for calls. And for puts, it's the in the money strike price minus the share price. So in other words, folks, there is absolutely no real value or no intrinsic value in an option if it's out of the money. It's only when an option is in the money that there's real or intrinsic value in that. So let's give you an example with call options of intrinsic or real value. Apple is trading at $110. The strike price of a call option is $105. So the intrinsic value of the call option at the 1.0 strike has to be $5. So let's think about this logically, folks. A call option gives somebody the right to buy a share at an agreed price by an agreed date. Now, if you buy a call option giving you the right to buy Apple at 105, well, if it's trading in the market at 110, that's giving you a $5 advantage. So that's real value. And that's what in the money is for a call option. It's that real value. So think about it. If you bought a call option, you could buy the right to buy the shares of Apple at 105 and immediately sell them at 110. Nobody in their right mind is going to sell you that call option contract unless you give them at least $5. It's the exact opposite for the put options. If Apple is trading at 110, and let's imagine the strike price of a put option was 115, the intrinsic value in the put option at the 115 strike is $5. So let's talk this through logically. A put option is the right to sell shares at an agreed date in the future. So if we bought the right to sell Apple at 115, when the shares are only trading at 110, that means we've a $5 advantage. So that means that anyone who's selling us this put option contract would want at least $5. Otherwise, why would they do it? It doesn't make any sense for them.